All rights and obligations of options instruments should be fully understood by individual investors before entering any trade. All right, so just one more check. So you guys can see the screen, you can hear me, everything's cool, right? See a bunch of yeses go by. Okay, good. All right, so let's get down into it. And I'll give you a way to get more, how to get information if you want a copy of my slides, you want more information. I'll give you the information at the end as to how you can get that. So here's the agenda, what we're going to go over today. So we're going to talk about what affects option pricing. We're going to talk about the two different flavors of volatility, historic volatility and implied volatility. Implied volatility is the one that's pretty exciting. People want to learn about, but you really need to understand historic volatility before you can begin to understand implied volatility. And then we'll talk a little bit on the VIX. I'm not going to talk a lot on the VIX, but we'll talk a little bit on the VIX. And then I'll just give you a quick overview of who we are and how to get more information from there. So first of all, what affects option pricing? I guess it helps to start with what are options. I'm assuming that this presentation is geared to people who already have some base fundamental understanding about what options are, but options really come in two forms. We have call contracts and put contracts. The call contract gives a buyer the right to buy a stock at a set price within a set period of time. The sentiment of the buyer would be bullish. On the other hand, there's a seller. Between any contract, there's two parties, a buyer and a seller. The seller has an obligation to sell the stock at a set price within a time frame, and his sentiment would be bearish or stagnant. Then we have a put contract, which is the right to sell a stock at a set price within a set period of time, and the obligation of the buyer is to buy that stock. And so you can see their sentiments there. So we'll talk more about those options, but just to put everybody on the same page, here we go. So what affects an options price? Unlike a stock, when you look at stock, there's only one thing that affects the price of the stock, and it sounds redundant, but it's the price of the stock, right? There's nothing else that can really affect the price of a stock. But with options, we have more moving pieces, and if you're going to trade options, you have to understand this. So the option value is impacted, obviously, by the strike and the stock price. So the strike is the price at which we execute our trade. So the price where we either are buying or selling, that is the strike, and of course the stock price would affect that. That seems pretty intuitive, and I think anybody who even has the most fundamental understanding of options would understand that. But there's some other important factors that impact option pricing, and those include time till expiration, the implied volatility, the risk-free interest rate, and if there's any dividends. All of these things, once you own a particular option, the strike cannot change. That's where it's written. So, but these other 5 things will impact your option pricing. And if you're going to trade options, you must understand how these 5 things can impact your options. So I really want to give you some insight. I mean, like the 2 big things I want you to take away. I want you to come away with a little bit better understanding of option pricing, but I also hopefully want to give you some insight into the VIX. I'm also probably not going to have a lot of time to be able to answer the questions. We've got 1,000 people here asking questions live, and like I said, I've got a few slides that I'm trying to get through. I'm on slide 6. I have 37 slides. I got 40 minutes. I'm going to be pushing it really hard to get through, but we can get your questions answered. So please, at the end, I'll give you the way to get your questions, how to get in touch with me, and we can get to the slides and get questions answered for you. So when we look at option pricing, there's really 2 components to the option pricing. So you get the price of the option, and part of it is the intrinsic value. Not to be confused with the stock's intrinsic value. That's a completely different thing. Same word, completely different meaning. But the intrinsic value of an option is the amount by which it is in the money. For example, if you had a stock trading at $100 and you owned a call at 95, that gives you the right to buy the stock at $95. If the stock is trading at 100, the intrinsic value is at least $5. The intrinsic value is exactly $5. The value of that option is at least $5. In fact, it's probably worth more than $5. But that extra value is the extrinsic value. It's everything greater than the intrinsic value. So for calls, any strikes that are lower than where the stock is trading is considered in the money. For puts, any strikes that are higher than where the stock is trading are considered in the money. A way to think about it is, what would it be worth if it expired today? And of course, the corollary to the intrinsic portion here is that any options that are out of the money have no intrinsic value. By definition, they're out of the money, so they can't be in the money. So the intrinsic value of out of the money options is 0, and every bit of value for out of the money options is the extrinsic value. So option price is equal to the intrinsic value plus the extrinsic value, just a straightforward formula. And if we're trying to find out the extrinsic value, we take the option price and we subtract the intrinsic price. I know you guys are really blown away by my awesome PowerPoint skills here. That didn't take me a long time to do. No, actually it did took me it took me a while. So what affects the intrinsic price, as we said? I mean, I've made it clear here. Hopefully you guys are sticking with me and understand that the intrinsic price is only impacted by the strike and the stock price. So those are the only two things that can impact the intrinsic value of an option. So another way to say is the intrinsic value is the difference between the stock price and the strike price, and out of the money options have no intrinsic value. Now, the other portion of the price, the extrinsic, I think a really good analogy, one that I like to use, maybe because I like beer, is if you looked at the height of the beer from the bottom to the top, that would be your option price, and the liquid portion of the beer would be your intrinsic, and the upper portion would be the extrinsic. Now, this is actually a good visual. It helps me remember things. I mean, if you've ever poured yourself a beer and let it sit there and didn't drink it, oh, heaven forbid, but no, stick with me, right? So if you poured a fresh draft and let it sit there, of course it wouldn't be your beer, it would be your friend's beer because you would drink yours, but your friend's beer because he gets a phone call and leaves. What's going to happen to the foam? The foam's going to go away. It's going to go down, right? That's the extrinsic value. Some people call the extrinsic value of options the time value, because a portion of that pricing is related to how much time is in the option. And at expiration, there is no more extrinsic value. All of the extrinsic value goes away, and it's due to time. Now, here's the reason why I like this analogy of beer. What would happen if I let that thing decay down a little bit, waited a while, got close to expiration, but then some clown came over and decided to stick a straw in my beer and blow bubbles in it? It would become frothy again, right? That can happen with options. You can have the extrinsic value get larger, and we do see that happen with options. We do see that happen with options. Sorry, I got a window that popped open here. Okay. So yes, and an extrinsic value is impacted by all of those. So intrinsic value, as we said, is only impacted by the strike, but once you own the option, the strike doesn't change. So the only thing that really impacts the price of the intrinsic price or intrinsic value of an option is whether the stock goes up or down. All those other things that I talked about, time value, implied volatility, risk-free interest rate, dividends, all of that, and including stock price, all impact the extrinsic value. So extrinsic value is like the foam. It can get frothy, but eventually it goes to nothing, right? That's just the way that it works. So let's use an example here. Let's use a stock that, a fictional stock, okay? Because this stock doesn't trade under this symbol anymore, right? Anybody remember this one back when Research in Motion was trading at 61? So just use as an example. It'd be interesting if it went back there, but that's and it's not even Research in Motion anymore, right? It's BlackBerry. But just for sake of an example, let's look at the puts. So let's look at the price of the puts. And this is actually an exercise that I did personally, and it's become part of our curriculum to help students. But when you take a look at that pricing and look at it, I mean, I'm an engineer by degree, and I look at things and I see patterns, and I like to put things in charts. It helps me to visualize. Everybody learns through different methods. This is how I like to learn. And so when I plotted these things, I said, okay, well, that's interesting. I see a curve. But that doesn't really tell me a lot. I mean, what can I gather from looking at that? So let's look at taking this and breaking it down and looking at the components that I've introduced to you, or hopefully you knew these ahead of time, intrinsic and extrinsic value, And if I do that, so the black would be the intrinsic, the green would be the extrinsic. So here's another mnemonic to help you remember. So you got the beer foam analogy. That's hopefully sticking with you. But I look at the first few letters. Intrinsic. It's the value that's in there, right? It's in there. It can't be taken away like Prego. It's in there, right? So intrinsic. And look at the first few letters of extrinsic. That's the extra value. That's everything above and beyond the intrinsic. So maybe those mnemonics will help you to remember this concept. So what's interesting is that if you notice the extrinsic and the intrinsic line, you notice I can draw a straight line, and it goes right exactly to where the stock is trading, which is exactly where the intrinsic value becomes 0, is right at where the stock is trading. So this stock was trading at 6109. If there was a 6109 strike, which there isn't, but if there was, it would be perfectly 0. And here you can see any of these are puts. So only strikes that are higher have intrinsic value. All strikes that are lower have no intrinsic value. So it's interesting. You don't have to be a rocket scientist to see this one, how the intrinsic price changes. It changes based on the price of the stock. That's the only thing that moves the intrinsic portion. So we have that down. You guys are now experts. You're up to speed. You understand intrinsic value fully. So let's take intrinsic value and move it out of here and get rid of it. So let's just look at the extrinsic value. And when you plot this curve on extrinsic value, anybody back there, do you see a pattern here? Do you see a pattern? I like to look, and I see a pattern. I see a picture that looks like what's known as a normal distribution, or sometimes the bell curve, right? And as a matter of fact, that's exactly what it is. And folks, this is some amazing stuff when you really look at it, because this is set by the market. This isn't theory. This isn't makeup. This is actual pricing. And you can go pull any option you want. You can do the same math, and you're going to see the same sort of stuff that exists here. And so this is statistics. Yes, Sally, we're going to learn about statistics. It's interesting that the bell curve applies, and there's several different places in options where the bell curve applies. And the content that we're talking around here is really. This is the stuff that won Black-Scholes and Merton the Nobel Prize in Economics for the so-called Black-Scholes model. This sort of information, and it's very interesting. So we have all kinds of tools and things to help us out. But let's look at extrinsic value here. And one of the things you notice, of course, the peak is at the money. The peak is at the money. And if so right now, if I haven't taught you anything, you're sticking with me lockstep, and it's good review for everybody. I think I'm going to teach you something right now. So listen up, and maybe you want to write this down. But the extrinsic value reflects the probability that an option will expire at the money. Don't worry about the absolute number, the value, or what it is. Just know that the larger the extrinsic value is, that means that option has the greatest probability of expiring at the money. What at the money means is that's the strike that's going to be closest to where the stock is on expiration. Now, some people are probably thinking about pinning or pegging, which is a really cool concept, but that's not what I'm going to talk about. That's really cool stuff, by the way. We're not talking about that. But based on what I just told you, where is the greatest probability that this stock is going to expire? I'm asking because I want an answer. There's no strike at 61. If there was, 61 would be the answer. But 60, exactly. 60 is where we think that's the closest place. Because, think about the probability of stock movement. If you were going to guess where the stock is at any point in the future, the best guess is where it is right now. That's just the way it is. So if the stock's trading at 100 today, and I said, hold a gun to your head and say, tell me where you think the stock's going to be tomorrow, the best you can say is 100. There's all kinds of stuff about technical analysis and fundamental analysis and sentimental analysis, and we can try to draw lines and charts and things, but the best guess is wherever it is today. So anything that impacts the probability of the stock moving to a particular strike. Let me repeat that. Anything that increases the probability of a stock moving to a particular strike will increase the extrinsic value. Okay? So what are the things that can impact that? Well, let's say if the stock were to move to 80, well, what do you think this bell curve would look like? Everything would shift out to here, and we'd have a peak here. Why? Because the stock's now trading at 80, and that's the greatest probability for expiration. Now, by the way, remember, these are puts. If the stock went to 80, your actual value would go down, because most of the value, if you remember, if we go back, let's go back a couple slides, most of the value of this 80 strike, this 80 put strike is going to cost you around $19 and change. But the extrinsic value will get larger, but the overall value of the option would go down. So that's why you need to keep in mind what we're talking about here. Now, of course, if the stock went down to, say, 42, then it's a put, right? So remember, we're talking about puts. The stock goes down, that generally increases the value of the put. And so now the largest extrinsic value would be here. And so we'd see an increase there. So stock moving is one of the things that can increase the probability. What if I had two options, one that expired in a month, one that expired in a year? What do you think this curve would look like? The curve would be much higher. So we'd see a curve that's higher if it was a one-year option, because there's more probability. I mean, if this option right here is, say, a 30-day option, it expires in a month, what are the chances of the stock going from 61 to 80? Not very good. Not very good. And that's reflected because the probability is very low. But if I gave it a year, well, you've got more time, so you get a better chance of it happening. So the concept that I want you to take away from this, and this will really help you to understand intrinsically and holistically, in your heart, I want you to feel it. What impacts the extrinsic value is anything that increases the probability of that option expiring at the money. Okay, so let's move on. So we're going to talk, I'm going to come back to implied volatility, but I want to talk a little bit about historic volatility first. So here's three imaginary stocks. Three imaginary stocks that are trading over the course of 30 days, and the average on all three of these is 100. So which one has the highest volatility? I mean, I like to say that volatility is like pornography. You know it when you see it, right? And I mean, I can ask my 16-year-old son, which one has the highest volatility? He said, Dad, that's C. Clearly, this one has the highest volatility. I mean, it's moving all over the place. And Bravo, B, would have the lowest. It's got the least volatility. And so how do we measure volatility? We don't want to use subjective things. We use objective things. So the term standard deviation is what we use. And you don't have to worry about how you calculate standard deviation. If you want to get into it, by the way, the convention is actually to use the annualized standard deviation of the logarithmic change over 30 days. You don't need to worry about that, okay? It's calculated for you. I will say that different websites do calculate it differently. So don't go to MSN Money and then go to Yahoo and compare the volatilities between the two. Whatever you use, you might be comparing apples to oranges. So make sure you're consistent in whatever you use. But we use this calculation, this standard deviation. That's how we measure volatility. It's another term in statistics. And so we can get objective readings using this calculation, and I can measure and say, well, geez, C has a historic volatility of 56.9, and Bravo 7.3, and Charlie's 19, or Alpha's 19.7. So those are the numbers. So let me help you a little bit here and show you how this works. So here we have a longer time frame. Here we have 90 days of stock trading, and if you're if you're one of these people that picks up patterns, maybe you will notice that those three stocks are actually, I just put them end to end here. So the way that we measure historic volatility is we look back 30 days and we take the standard deviation. And then as time moves forward, each day we're rolling forward, we're calculating a standard deviation. So it's just basically looking back the past 30 days. So here's some examples. This is the historic volatility. I updated this data last night on the SPY. You can see the SPY moving around here. Now, here's another one that people like to talk about, and that's Netflix. And one of the reasons, the things that I need to point out here, I want you to see this, is notice these things that look like Devil's Tower. Remember? What was that? Close Encounters of the Third Kind? You know, Devil's Tower. So you see these things that look like tables here. So remember, this is a 30-day rolling calculation. And so what happened to make this spike go up? It was this gap where Netflix was trading around 80-something and then dropped down to 60-something overnight. And so we saw a big drop in the stock, and that increased the historic volatility. Remember, volatility is not bullish or bearish. It just tells us that there was a lot of volatility. So what happened out here? Now look at the stock during this period of time. What made that drop in historic volatility? And Gary, I mean, I see people saying earnings. Yes, this was earnings, right? This was definitely earnings. So why did the historic volatility drop? So it dropped precipitously. It's a rolling calculation. And the reason why this dropped was because 30 trading days ago, this calculation is no longer in the calculation. So people sometimes will make some pretty large conclusions about changes in historic volatility. An increase in historic volatility tells you something. A drop in historic volatility doesn't. I mean, I've seen some people, so-called experts, saying, oh, the historic volatility just crashed on Netflix. Who gives a rat's patootie? It happened 30 days ago. It doesn't mean anything. This drop doesn't mean anything. It tells you what happened 30 trading days ago. And again here, so here we see another rise up. I mean, look at Netflix went from like $100 up to 170 in a matter of a few days. It's crazy. And then, of course, it was still, I mean, you can look at these movements in here and say it's still pretty volatile. And even the low point in here is somewhere around 70 or 80. That's still very volatile. That is still a very volatile stock, no question. And then you see this big drop down here. And that's because this calculation is no longer, these moves here are no longer in the calculation. So historic volatility is really cool, but the drops don't really tell us much. By the way, a term that's used a lot in trading or in the trading realm is beta. I'm sure a lot of people have heard about beta. And what beta is a measure of correlation. Normally it's to the S&P 500. So it's how well the volatility correlates. If the beta is greater than 1, you can conclude that the stock is more volatile than the S&P 500. That is true. But there are people who seek to avoid risk by choosing low beta stock. And that could not be further from the truth. If you don't believe me, go look at the beta in Netflix right now and tell me what the beta is in Netflix. It's lower than 1, okay? What it means, what beta is correlation of volatility. And if it's less than 1, all that tells you is it's not very well correlated. Okay, so be very careful about seeking low beta stocks. And another one I hear people say, oh, I trade low beta because it's, low risk. Well, baloney, it's not low risk because Netflix is actually probably the opposite of low risk. It is one of the most volatile stocks that are out there. So yeah, so somebody looked it up. It's 0.84. It's less than 1, right? So be aware of what low beta means. In fact, that's a good test when you're trying to figure out if somebody knows what they're talking about. Ask them what low beta means, and then to yourself, you know whether they know what they're talking about or not. So let's change gears. Are you ready? So implied volatility. You having fun, by the way? Can you tell I'm having fun? I love this stuff. And man, I'm running out of time. I want to go on. I deleted like 10 slides from this presentation in the past 24 hours. Oh, it's killing me. Okay, but we'll get through this. So implied volatility is the volatility, as the word implied would say. It's implied to happen over the life of the option. So it represents the future risk of movement. Pretty wild concept. It's not bullish or bearish. It's just a prediction of how much movement we can have in the future. A way to think of it is a measurement of risk. And a good analogy that I like to use is homeowners insurance. So imagine there's 2 homeowners, each has a house that's worth $500,000, and they want to buy a contract for insurance for, say, a month. And this is equivalent to a put. This is exactly what a put is. It's insurance for your stock. So they want a $500 deductible. and they want $500,000 worth of protection. So the home locations, well, one's in Cleveland and one's in Miami. So who do you charge more money? Oh, and by the way, your assessor sends you these photos. Here's a picture of one homeowner's house. In Cleveland, you get a lot of home for the money. And, oh, here's Miami. Oh, and by the way, there's a hurricane coming. I mean, put yourself in the shoes of the insurance company. Who are you going to charge more money to? There's a hurricane bearing down on South Florida, and somebody wants to buy insurance, 2 days before the hurricane comes. You're going to, there's regulations about insurance, but let's forget about that sort of stuff. But, why? Who are you going to charge more money to? You're going to charge more money to the person in Florida. Why? Because there's more risk. There's just no question about it. There's more risk. So you're going to charge more money to Miami because they got a greater chance of something happening. Now, in trading options, an event like this might be earnings. Now, earnings can be good or could be bad. So our hurricanes can do one of two things. They can destroy your property, or they can rain gold from the sky. So Apple earnings next week on the 23rd, the implied volatility is high right now because there's a big risk of Apple moving. And so all options are expensive. That's implied volatility. So an increase in implied volatility increases the option pricing. It's a measure of potential risk. Again, it's not bullish or bearish. It's just looking and saying, is there a potential for movement? So it makes the option prices go up as implied volatility increases. Go back to what I talked about, extrinsic value. So the reason why option prices go up, because it increases the likelihood of a particular strike expiring at the money. Because the stock now has a big potential to move. In fact, you can write this down right now. I'm gonna make a prediction for you, and this is one thing that if you want to learn how to do it, I'll give you the number at the end, and we can help you figure out how to get this information. But write this down on a piece of paper. Eric Hale predicts that next week Apple will either touch 365 or 418. Okay, and I got that from the option pricing. The market is telling me how much Apple's going to move. So it is either going to move down to 365 or 416. I don't know which. Am I trading it? Yes, I am trading it. So, and I'm using that information to factor my trades. So here's an example. This is a tool that Trade Monster has, and they call this a volatility cone. And so here's a stock price, and I'm looking at an implied volatility. You can see here it says implied volatility forecast, and it shows where the stock could move. So greatest potential is going to be right where it's trading right now. It's trading right around 100, so that's the greatest potential for where it's going to be in the future. But it could also move up. It could also move down. Now, I can come in here and tweak this and change the implied volatility to a different number. And if I increase it to 50, you see now I have a bigger cone. And that shows the potential of how far, where the stock could potentially go. That's what the market's telling me. And folks, getting to understand this implied volatility thing, it is one of the biggest, best kept secrets in the market right now. I know there's lots of people out there that have technical analysis, and this isn't anything proprietary. But we teach you how to use this information and factor it in. This isn't anything secret. This is implied volatility. Although some people would rather it kept it a secret, but the market's telling you where this thing's going to move. And write down what I said about Apple in case you missed that number again. Apple next week will hit 365 or 418. And I'm willing to, I'm actually trading it, putting money on it myself. So you see next week whether I'm right or not, and we'll see where we go. I'd like to hear back from you too if you whatever happens. So implied volatility impacts the extrinsic value. So going back to this thing, this is what happens. You see, as earnings approaches, you see all these options getting more and more expensive. And then what happens? Anybody here trade options? You know what's going to happen next, right? Earnings happens. And kaplooey, the option value just disappears overnight. And this is one of the trades that a lot of people like to do is buy straddles or strangles before earnings. That's buying a call or a put, right? The call makes money if it goes up, put makes money if it goes down. I'll buy both. So if it goes up or down, I make money. Well, unfortunately, you get hit by what's known in the industry as volatility crush. And so your option pricing goes down. Why? The hurricane passed. and it either destroyed my stock or it dumped a pile of gold on it. But regardless, I don't need my options anymore because the stock did what it's going to do, and all the movement happened. And that's going to happen if you know, so I told you where Apple's going to be, and some of you probably said, I'm going to go buy a straddle. I'm going to buy a strangle. Don't. You're probably going to lose money, and you're probably going to lose money because of this. There are ways to trade it. There's other ways to trade it. I wouldn't buy a straddle or strangle. And most straddles and strangles, there's some research that was done by Goldman Sachs looking at over 100,000 events. And in the long run, buying straddles and strangles is a losing proposition. Yes, they work sometimes. Yes, they work sometimes, but they usually lose money because of this. So it's important that you understand. We're talking about what affects option pricing, so you need to understand this. If I taught you something here, good. I want you to learn more. So now what about the two things we just talked about? We just talked about historic volatility and implied volatility. Now, iVolatility.com is just one source. There's a number of other places out there that have these charts that show the gold line is the rise in implied volatility. The purple line is the historic volatility. So let's look at this in Netflix right here. What was happening to the implied volatility up until this point? Was earnings was approaching. And if you look at the purple line, remember we were talking about Devil's Tower? Yes, there was a big movement in the equity. It made a huge move. This case happened to be down. I didn't know that it was going to go down or up. I just knew it was going to move. And I knew options are very expensive. And the real cool thing, and one of the things we teach at Options Animal, is how to make money. Where's the risk? I mean, the risk is right here when there's after this point. But we teach you a strategy on how to make money off of this. Before the stock moves, how do you make money on the fact that options are getting expensive? And it's a really cool strategy that we teach Vega positive, delta neutral trade. So if you trade options, maybe you know what that is. Not an iron condor. On iron condor, if you did an iron condor before earnings, you lose money. So anyways, so comparing these two, if you don't even use it for trading options, you just use this as a warning signal. I like to tell people, anybody play poker out there? Do you know what a fish is? A fish is the person at the table who's going to lose money. And guess what? If you at every table there's a fish. And if you can't pick out who the fish is, guess who the fish is? You're the fish. So if you're sitting into a stock and implied volatility is going up and you don't know why, you're the fish because you're going to lose money. So you need to understand this. This is really good insight into anybody who's trading. You know, a warning. This is the hurricane is coming. The stock's going to move. And look, it happens every quarter. So this is a very valuable thing. Hopefully I taught a lot of you people there. So let's talk about the VIX. People like to talk about the VIX. What exactly is the VIX? So the VIX is an index. It's essentially the implied volatility of a theoretical at-the-money option on the SPX that expires in 30 days. So it attempts to predict, remember, what implied volatility is trying to do is predict the future volatility. It actually tries to predict, this specific VIX tries to predict the historic volatility that's going to happen in the next 30 days. So how's the VIX calculated? Well, you get in the time machine, you go forward 30 days, and you measure historic volatility. Okay, I'm being facetious, but that's really what this implied volatility index is trying to do. It's imagining if I could travel forward 30 days and then look back 30 trading days and measure what happened in the market. That's what the VIX tries to do. Unfortunately, using a time machine is not that easy. It's harder to calculate than a time machine. Okay, I'm joking again. So I'm going to go through this real fast, and you can go and get the white paper, but you use 2 months of options, use out-of-the-money options, anything that has a non-zero bid, determine a forward price, calculate how many minutes, then you do a whole bunch of more math and you multiply times 100. So, I mean, you can go get the white paper from the CBOE if you really want to know how it's calculated. But why go over some of that? Because the VIX is very complicated. There's a lot of moving parts on the VIX. Okay, and anything that has moving parts, if there's any engineers out there, any scientists, any mathematicians, you know, when you start getting into some of these complex models, you start seeing some weird things that can happen. So anything that's complex can have quirks, and the VIX has quirks. For example, you only use 2 months of options. Well, eventually you have to roll to the next month. So when there's 8 days left till expiration, you roll to the next month. Do you think that impacts the price of the VIX? Yes, it does. The forward price is calculated. So these other things, using only out-of-the-money options, using only options that have zero bids, all of these things impact the VIX. And these things can be impacted by, first and foremost, implied volatility, which is what we want. We want implied volatility. That's because that's what we're trying to measure. That's what the VIX is trying to measure. But market makers moving the bid-ask spread, large trades placed at very specific prices will move the VIX, even small trades. I've been able to demonstrate that anybody listening here with $50 can move the VIX. I'm going to have a spreadsheet. I can just go into the spreadsheet that calculates the VIX, and I just change one little price, which would be the equivalent of a $50 trade, and the VIX changes. Hey, that's great. You can put it on your resume. People will flock around you at cocktail parties because you moved the VIX. Who cares, right? But the point is that, I listen to CNBC and they're like, oh, the VIX changed. Why did it change? I'm like, hey, it's a weird number. Things happen. Who knows why it changed? And so there's some additional quirks, like, for example, it looks forward 30 days. In December, there's extra holidays, so there's less trading days. So we have the same volatility spread over less days, so it actually looks like the volatility is lower than it is. There's skew that happens because there's a difference between puts and calls. News, even good news, can make the VIX go up, so people think that's fear because the volatility can change from good news. So there's lots of quirks on the VIX. Lots of quirks on the VIX, and you have to be careful. And I know I'm going super fast. You guys are like, your heads are spinning now, and I apologize. And believe me, I took 10 slides out of this, and we're getting close to the end here. I got 6 more slides to get through. But I got to leave you with some very important messages, folks, okay? So now for those folks that are out here, people who say, I know the VIX, Eric, I knew all that. I learned a little bit, but I already knew all that. So here's a quiz. Can you trade the VIX? You're afraid to answer? No, you cannot trade the VIX. You cannot trade the VIX. I know. You can get quotes on it, but you can't trade it. You're not trading the VIX. You're trading something else. It is not the VIX. And if you've tried trading it and you lost money, you didn't understand, it's because you're not trading the VIX. You're trading something else. And so you smart people are saying, well, some people are saying, and you're all smart. You wouldn't be here if you weren't smart. And I commend you for taking the time to improve and learn and commit yourself on a beautiful Saturday afternoon to being here. But can you trade options on the VIX? No, you can't trade options on the VIX because they don't exist. You can't trade the VIX. It doesn't. There's nothing to trade. There's nobody to trade with you. There are no options on the VIX. And there's some people right now banging their fist on the table saying, Eric, if I go to my broker, I see VIX options. Those are not VIX options. What? It says VIX options. It looks just like the SPX options or the Apple options or the Google options. Those are options on futures. VIX futures. You can trade options on VIX futures, which is different than the VIX. To put things in perspective, it's like, I'll come to that in a second. But so you can't. You're trading options on the futures. Can you trade VIX futures? Most of you can't trade VIX futures. You need a special account. You have to find specific brokers. A lot of brokers that you have out there don't even have VIX futures. So the answer to the first is no. You can't trade the VIX. You can't trade options of the VIX. And there was a bit of a trick question. You can trade VIX futures, yes, and you can trade options on VIX futures. Most options traders have access to VIX futures options, but don't have access to VIX futures. You have to get a special account to do that. So let's talk about the VIX and manipulation. Why can't you trade the VIX? I told you, I personally could trade, I can move the VIX with $50. Woohoo! Who cares, right? Put that on my resume. Go to a cocktail party, like I said. You're in a cocktail, oh, you're cool, man, he moved the VIX. Who gives a rat's patootie, right? Well, the reason why they're not trading, do you think Goldman Sachs, if they had the ability to manipulate the market, they wouldn't do that, would they? No, never. They wouldn't put a few $1,000s over here and put $1 million over there, put a few $1,000s into moving the VIX, and then you got $1 million over here. So because it's derived from out of the money options, it can be manipulated. Okay, the VIX can be manipulated. There's no question about it. Everybody knows that. And that's one of the reasons why I don't get terribly excited about the VIX moving from day to day. Sometimes there's just quirks. If somebody placed a big trade out of the money, the VIX will move. And maybe it was just that. I don't sweat it. I mean, I look at the general trend over 5 days. That means more to me. Sometimes you see spikes. Sometimes it's moving for reasons, real reasons. So I'm very cautious about the VIX. But VIX futures are priced by the market. So the future of the VIX, and those can be traded, mostly are traded by institutional traders who are hedging their portfolios. Okay? So the VIX, how would you calculate the fair market value of the VIX futures? VIX future, are they impacted by the SPX options? They're not directly, but since the VIX is calculated based on SPX options, then it's logical to conclude, Captain, that VIX futures are correlated to the corresponding SPX options. In fact, the successful traders of the VIX futures and options, VIX futures and options on VIX futures, are using sophisticated models that price in the SPX options to calculate what the future VIX should be. And then they do a fair market calculation. If you don't have the ability to do that calculation, you are at a severe disadvantage of the big players out there. And I know people sometimes say, I'm going to go trade the VIX just to figure it out. Well, it is really subject to volatility, to manipulation, and you could find yourself easily on the wrong side of it. So VIX futures can be manipulated if you believe in this correlation. And so I've seen it happen myself. So how do you trade the VIX? Well, I'm being a little facetious here, but let me show you an example of a trade. So anybody here know what a calendar trade is? Calendar trade? So let's say that on this particular date, the VIX is trading at 23. If you were to do a trend on this, you might say that VIX looks like it's range bound. A good trade, say it's stagnant. A nice trade to do sometimes when it's stagnant is a calendar trade. So if you buy to open the December 25 for a $2 debit and then sell the October for $1.50, that particular trade costs 50 cents. 50 cents, that's how that trade works out. What's the most that you can lose on a calendar trade? Anybody here know what a calendar trade is? What's the most you can lose on a calendar trade? The most that you can lose on a calendar trade is usually the debit, but not in the case of the VIX. Let me show you. Real money here. These are real quotes. So on October expiration, what happened was we ended up having, because you're actually trading options on 2 different equities here. This is like buying a call on Coke and selling a call on Pepsi. Normally they trade together, but sometimes they don't. On this particular trade, the December 25 call went from $2 to $13. You bought that. It went up. That's good. That makes you happy. However, the October that you sold for $150 is now $38.35. And this trade, which people did, ended up losing $25. If you did a trade, so let's say, for example, you want to put one of these collars, one of these contracts on, and you say, hey, 50 cents, that's $50. I'm going to do 10 contracts, $500. Most I can lose on a calendar trade. If you did this trade thinking the most you can lose is $500, you would have lost $25,700. Try explaining that to your wife or your husband or significant other or whatever. I mean, it's just, this had and this happened to people. If what I just told you, your head's swimming right now. If you're not lockstep, you understood this. You need to understand this if you trade in the VIX. And I'm telling this more as a public service warning, because don't trade calendars in the VIX. This can happen. And there's people out there who are supposedly professionals telling people to trade calendars. It makes me cringe, because this happened. And when I talk to them one-on-one and say, hey, you know what happened? Oh, yeah, well, that was 2008. That doesn't usually happen. Well, it did happen, and it could happen again. And there's been times when these things have happened again, and since. So it's just there's too many other ways to make money than to mess with that. So let me wrap up. Historic volatility looks backward. Implied volatility looks forward. Implied volatility can be managed and traded. Be very careful trading the VIX. You're playing with the big boys. There's manipulation that goes on. Oops, is that my bell? Does that mean it's time? I'm up? Uh-oh. Okay, I'm almost done. So be very careful on the VIX. You can make money trading options, and Options Animal could show you how. So let me show you some real results. So we do portfolio trades in our accounts, and we as coaches share them in real time using our methodology. Now, we're not a trade recommendation service. I tell people, if you need somebody to tell you how to trade, go find somebody to give your money to. We teach you how to trade because nobody cares about your money more than you. And so just the example, these are real trades. I mean, all the trades are published and out there and still available for you to go back and look at. These are not back tested. These are real trades done when the market's open. And so we've had 145 trades. 11 of them are still open. 9 of those trades have been closed for a loss. So 125 of our 145 have been traded profitable. Average duration of the trade is 48. Average ROI is 8%, and that includes the losses. So annualized ROI, if you take the time value into effect, it's a 20% annualized return on the trades that we do. The advantage that we offer Options Animal is that we teach you how to adjust. By placing the right trade first and having the right plan in place, what do you do when the trade goes against you? And that's really where our profits come from. So fully 45% of the trades, or 45 of these 145 trades, needed to be adjusted in order to get profit. We still had a pretty good record over here. 80 out of the 145 were profitable at their primary exits. But we've got a win-loss ratio of 93% and 34 requiring adjustment. So with that, I went really fast, and I think I went over. If you want to get my slides, you want to ask questions, we actually have a special right now, and you can get access to this for free. So if you can call this number, either 888-297-9156, or if you want to call internationally directly, the number is 1-801-331-7500. If you call now, we can get you hooked up and get all your questions answered. So you got questions about the program, questions about, you want to see the results, you want to kick the tires, you want to look at this. So right now we actually have a way that you can get access to this for free. And now I'm done. How'd I do on time, man? Morgan, are you still there?
Yeah, excellent job. So, Eric, you can take a breath now.
I love this stuff, man. I love helping people, and I've been doing this for 5 years, and it's just been a pleasure to really be adding value to people's lives. So, anyways, I'll leave it to you, and thanks for the time. I really appreciate it.